and welcome to TQ Talks, where we talk taxes and tax-free living 365. Here are your hosts, Craig White, Sebastian Singh, and Patrick Augustin.
Hey guys, it's good to be back with our podcast, TQ Talks.
TQ Talks.
Man, it's been a
took
while.
A break, man.
COVID does that.
COVID started, and then life.
Intentionality.
Intentionality.
We're using that word from the onset because that's really what we're going to try to talk about throughout these. If you guys have never been with us before, our goal is to educate you guys on everything financial related. We are definitely focused on the tax realm. We are a tax and advisory firm. We help people to look at different ways of investing and creating wealth for yourself and generations to come, and also using taxes and the tax codes and deductions.
Yeah, and you know what I like that Pat always pushes is that we specialize in tax planning.
Yeah.
So it's not just preparing, it's not just doing the numbers and spitting stuff out,
Mm-hmm.
but it's really getting to know your client and understanding what their goals are.
Yeah.
And how they should be structured to accomplish what they have set out. So that's where the planning comes from a lot.
Right, and if you're a client of ours, quarterly, that's our goal. We reach out at least once a quarter, 4 times a year,
right?
Because the real magic comes after tax season. We got to do everything we can to put you in the best position to be successful after the season. Not handing us paperwork and then saying, "Hey, magically make something
figure
happen."
this out." Yeah.
So
what's important also is knowing the changes that happen. Throughout the year, and getting our clients ready for how their money will shake out at the end, what deductions they can have,
mm-hmm.
and what would best benefit them.
Yeah.
Whether that be lessening that tax liability,
Yep.
or increasing the refund, or just with all these changes having to do with the stimulus, and then also all the child payments and everything.
And we'll get into all that stuff.
A lot of changes.
Yeah,
so we like to keep up with our clients
at some point. So this podcast, we want it to be right now the biggest word on the streets right now is be your own bank. That's a phrase that seems to be all over social media. Every person and their mom is dropping that in.
Yep.
Oh man, and it's actually a good thing and also quite annoying. From our point of view, because we understand the business aspect where people like, hey, be your own bank. They're not going to tell you how. They're going to give vague information and then sort of hope that you join their program.
Hook you in. Yeah. So then you got to go to the seminar, and then you got to buy the book, and you got to buy the program.
And it's cool. We suck at that.
And as long as I'm definitely not going to knock anybody that it works for. So if it does work for some people, go for it. We think they're less expensive, definitely.
And
ways to get the same information.
It is, and we'd rather, again, our goal is always to give you guys. We used to use this phrase all the time since we've been fighting with trademarking. We're not doing it, but educate, elevate, and empower, right? And so we're going to continue to do that. Of course, the goal for the business is to make money, right? That's what we teach our clients. That's our focus as well, but in a way that it helps you. And then you turn around and help others. That's the full intentionality, there's that word again, of our business. That's why we're in business. We have to help everyone to grow. So let's do a deep dive into this whole be your own bank scenario that everyone continues to push.
So of course that has to do with life insurance, right? And getting money out of the life insurance.
Yep. Whole life specifically. And I believe Waka, credit to Waka Flocka.
Waka Flocka.
Yeah, who would ever think that in life?
I love that guy, man.
Listen, the screaming. I used to listen to this stuff all the time, but
at the gym,
of course. Not with the intent that it's good rapping, but he's awesome, and he says it himself. He's not a rapper.
Good energy.
I love it. It's awesome. I can't knock it. But he came on whatever show it was, and our apologies for not being specific with that, but he had talked about it. He said, hey, what I've learned from my rich friends, and he used other words, whatever, but he pretty much said 2-3 million, drops it into his whole life or into life insurance, but specifically it is whole life plan, and then he turns around and borrows against it. That part alone, right, from our standpoint, understanding life insurance, understanding whole life, understanding other things like IUL, which is Index Universal Life, and other programs of that nature, we know the value of having a large sum of money versus the normal person, normal individual who's not coming out of here swinging with $2-3 million.
Right.
Because part of the frustration on my side when I listen to it,
is that not everybody can drop
yeah,
2 to 3 million.
Right, because the way they're becoming their own bank is by having the 2-3 million and putting it in,
right,
automatically having that capital to leverage against,
and then you can do whatever.
Right,
exactly.
But when you're coming in with, $100 a month, $200 a month, you're not pulling money out. All right, you're not going to be your own bank at that level.
You're not dropping it and like you said, pulling it out right away.
It doesn't. So some of the basics to understand is, most of the time when you're doing these kind of cash value life insurance programs, there's an idea that it is a long-term building product, meaning you're not overnighting successing. This is 10 years in the making, right? You're putting it in, saying, look, I'm going to close my eyes, set it and forget it. I'm going to continue.
We hate using that, but we love using that.
It's the truth. Set it and forget it, man.
Yep. We let it sit right there.
You're feeding this program, you're feeding the monster with the idea that in 10 years, 11 years, 12 years, I'm going to look back, it's going to accumulate a lot of money. We're going to explain why. And then I'm going to start to yank from it, right? And I think that part right there is why a lot of people aren't rich. Because to actually have that focus for that time, it's like, especially right now.
No, man, I think
especially
with us,
right
it's just, or when I say us, I mean our communities or our client base. A lot of times we're okay doing that with like a mango tree, right?
There's
that
that
you get
scenario.
from your mom or your grandma,
scenario.
And you're like, yeah, just let it sit there. And of course, year after year, you're eating tons of mangoes.
That's after it's bare. It's going to take time.
Right, but you had to wait.
Bear fruit.
It's the same idea with us when it comes to money. In our communities, at least, we don't have that mindset yet.
How long? So that's part of the struggle.
That's on us. On us, I mean you, myself, Patrick, and getting it out to our clients and just people around us. Like, the more we educate, the more I think people have money to put aside.
Yeah, they do. But do you want? So where's your focus? And we're going to get back into the whole cash value point, but that's a huge topic. Is the focus of wealth is different, right? And so what happens is other people look at wealthy people and say, wow, they have this, that, and third. Why don't we have it, right? Especially as people of color, we're looking back and saying, oh, we got to create rules. My wife is a big advocate, shout out to RC Law Group, big advocate of creating and making change and this. And we battle all the time because I don't care about it.
Right.
It's sad, but I don't care. I don't care for laws that create change. But let me explain why. Because the information is already there. So I don't think, and I told her this yesterday, funny enough, having that conversation, Hasbro is not going to change its rules to make you happy. You better learn the rules of Hasbro and follow suit in order to win the game.
And I'm in between. Yeah. You know, I love Rhea. Yeah. She's amazing. And I like where she's at with it, but I also see where you're at with it. Until those laws are changed, until that happens on the back end, let's learn how we can benefit now. And like how everything's set up now, how can we make the changes in our communities? But I think it's just getting this information out to our people.
Yeah, but application.
Excuse me. And they'll, at some point, start seeing it, right? They'll talk to you. They'll talk to me.
That's a positive. I don't have that kind of. I don't have it.
All right. Well, we got to give them something positive.
So listen. I don't have. All right. Well, let's give them that positive.
That's
so look,
okay.
When it comes to cash value, let's go into the details of it. Whole life, if you guys don't know, is life insurance. So we're not going to get into that. But you have term life, which is for a set amount of time, a set term of time. So 5 years, 10 years, 15, 20, 30. It doesn't really matter. You're paying money. There's a whole bunch of different options, but you're paying this money. And the money then gives you, right, you're telling the life insurance company, I'm going to give you this money in hopes that, or God, not hopes, in the event that I die.
In hopes that I don't.
Yeah, don't. But if I do,
but just then, in case.
Right, the beneficiaries, whoever I leave this money to, not kids, not kids, not kids,
right.
Not kids. We've said enough, right? Don't do that. There's enough information out there for you guys to know. If we need to do a podcast on that, we will, but not kids. But I leave the beneficiaries, they get that money tax-free. Right. Fantastic, right? But everyone cries, oh, the money comes. I've spent all this money over this time, this $10 a month.
Yeah,
ridiculous,
all
right?
This money.
Jeez, $120 a year. You couldn't even buy a Jordan yet.
Yeah.
And it's going to give me $150,000, $200,000. Somebody's going to get it and change their lives if they're financially savvy and understand I'm not going to go squander this money. But we're going to cry about the $120. That's me on my negative. But that's term. Whole life says, hey, life insurance should last our entire term, right?
Right.
Our whole life. So we're going to keep paying this money. The problem is with whole life, from my perspective, is that, and from a company's perspective, is that you're spending more money for less value. So I'm going to turn around and pay, I don't know, $120 a month to get the same whack return on my investment. So from a financial advisor standpoint, you're going to sit there and say, well, that
doesn't make any sense.
Doesn't. Buy the term, take the difference, invest in whatever the heck you want to, because that's what you should be doing theoretically. Now here comes the build your bank side. The build your bank side, you have like things like IULs, right? IUL is an Index Universal Life. You guys can look it up. A lot of information out there.
We've done videos on this many times as well, but we'll continue.
It's there. The point of that is to say, hey, here's a way that when you start putting those premiums, those monthly payments in, instead of it going to us, right, the majority of it going to us as the life insurance agents, we're going to take that and we're going to invest for you. You're going to take the money, theoretically, we're going to mimic or follow the S&P 500, NASDAQ, some indice, and we're going to say, if you're contributing, I'm making it up $100 a month. We're going to try to get at least 80%, 90% of that money to go into the investment portion. So that means it's a boo-hoo for us as the actual life insurance agent. So you're not making a lot of money, but it's an awesome thing for everyone else because it helps you to grow. So first year, it's a wash. I'm telling you guys right now, you're not going to see anything. You got to pay the insurance company, the agent,
everybody gets paid.
Second, third, fourth, it sort of starts trickling in. The fees aren't bad, but the whole point is that now this money can grow tax-free theoretically. We're going to get into that. And with it following whatever's happening, if the S&P is doing well, it goes well. If it doesn't, it doesn't. The difference between that and, let's say, a stock market would be if I'm in my 401k and the market craps out and goes to a negative, then with IULs, most of them give you a zero floor. That means
so you're not losing.
Not losing. I'm stopping at zero. I don't have a negative.
Biggest thing for me, I'll tell you, me,
right?
Because you already know, like, I do my own stuff on the side, and I hate losing. I hate it just like everybody else. So if you have that zero floor,
right,
you can't go under it. You can't lose.
Right, and that is big because I say everybody knows. I'm about to say that probably wrongly, but we all know, we should know that it's double. If you lose 10%, it takes 20 to get you back to where you were when it's an investment. So when you have a zero floor and you don't lose at all, when you're trying to climb out that hole because the market did 20% this week or whatever the case is, I'm already shooting. Right. I'm already gone. You guys have to catch up. So if you're putting money into this IUL or whatever the case is, and you're piling, and you're putting, again, this money as time goes on and the market does yay and nay and up and down, doesn't matter, it's giving you that income building asset, right? And that's huge because at some point you're going to look in and say, wow, I've contributed X, but I have X available.
Right.
Now the being your own bank and tax-free pulling money, because what you're doing is you're borrowing against the money.
Your growth, right? But you've also allowed it to grow enough that you can borrow against it.
Right.
And they're going to be okay with that because they're still growing money on the back.
They're constant. Yeah, even when you borrow against it, it doesn't stop the formula from continuing to produce because they're borrowing it with the thought that I'm putting it against, I'm leveraging, that word we always need to know, leveraging against the life insurance death benefit portion.
Exactly.
So even if I'm borrowing, I'm making this guy up, guys, 10 years from now, you start borrowing, I don't know, 50, 100,000, 75,000 a year, it doesn't matter. You're never going to pay it back. First of all, loans, there's not taxable, so it's irrelevant.
It's against your own money.
Right, it's against my own money, so that's how it's tax-free because I'm taking this money out and I don't have to pay taxes because it's a loan. Right. That's the easy part to understand. And then if I borrow $100,000 every year for 10 years, which is $1 million, as long as my death benefit is above that, if my death benefit is 1.9, then
it covers.
It covers, and then my beneficiary still gets $900,000. So again, back to that Waka thing, it's cool to push that in because he's quickly creating a heck of a bank by dropping that large amount in, and the growth for him is going to be faster, skyrocketing versus the large sum of money, right? But when it comes to us, it's a slower process. Now, there's another one, Flex Method, which we are grateful to have the communication.
This Flex method is going to be a game changer.
It is.
At least for our clients.
Right. And so we're blessed to always, I don't know how God always puts us in, but we're in contact with different people, and we're not going to give too much details. We're going to give you. So the Flex Method runs similar to an IUL where there's contributions. Now, you said what you don't like is losing. What I don't like with things like the IUL and products like that is that I have to constantly be putting money in. So let's say we have them, doctors, lawyers, whatever. They're good. They have money. They say, hey guys, IUL is fantastic. I don't want to contribute to my 401k because I don't want to take the loss, much like Bassy just said. So you know what, guys, we're going to drop in 10 a month. Okay, cool. Well, that's 120 a year, right? And so next year comes, you got to do that again. Next year comes, you got to do that again.
As long as we continue to have good years.
But what happens if they get sick? What happens if they get fired? What happens? Whatever your job
is. If we have a down year, expenses go crazy. Whatever happens.
You're not contributing, and that to me was always a scare of an IUL is that. With any of those things, even whole life, again, whole life is going to give you 2-3% dividends. We're not going to go on that. But if it's giving you this, if you're paying every time, that's cool. But when you can't, to me, that's a heck of a thought. You know what I mean?
Yeah, that's where it gets scary.
It does. And things like, it's a bunch of stuff. Recession, then COVID, then, you have so many factors that are happening that it shows you the instability, right, of life. And so I never liked it. So people would come and say, we've had this conversation with clients, and it's like, okay, we can contribute $5,000 a month, $3,000 a month. And I'm like looking at the stuff, the balance sheets, the budget, thank you, with them. And I'm like,
maybe.
Yeah. Why don't we drop that down to
but let's be a little more realistic.
Correct.
You need to have that saving just in case.
That cushion, right? And
so you never know what happens.
It restricts them because now when you're not putting as much in, obviously the growth value is not there.
Right.
So here comes a flex method that says, listen, we're going to do something that's radical. We're not going to have you contribute every year. You contribute one time, minimum of $30,000. And we're then going to go to the bank and we're going to tell the bank to contribute on your behalf for the rest of the time. And
against that initial 30.
Man, that's crazy. Or whatever you put. It's 30 goes up. You have to do it. So
if someone else is doing the investing for you, they're backing it.
It's nothing for you. Like to me, it was so hard to comprehend. It was easy to comprehend, hard to stomach. Because when it's too good to be true, I'm sorry. I'm calling BS.
Yeah.
And of course, how we are detail oriented. We dug. Guys, listen. At the end of the day, if you have money and you're a conservative investor and you want long-term growth, if you're trying to diversify your portfolio, and you can still do your stocks, bonds, all the investment stuff you're trying to do, this one where you do not have to put your own money is ridiculous, because you can sit there and put in, again, a larger lump sum of money and then have that, continue to grow as the bank is feeding you year after year. So it's not 30, it's 60 or to 90. And again, in addition to whatever you've gained. You see what I'm saying?
It's on top of what you've already gained.
On top of.
And we'll get into all the details, like different specific situations.
We could talk to, man.
Yeah, it's a game changer. Either way, IUL, Flex Method, whatever, they're both beneficial.
They're huge, right?
And going, at least for me, going away from what we've traditionally been fed as a life insurance, the whole or the term, like that's all.
Or just investment in general, right?
Yeah, true.
Because that's a big issue too. Like
it's not just the life insurance.
It's not Dave Ramsey. His books are even. Oh, you can't see Dave Ramsey's books are down. We read all the stuff. But when you're stuck in a position like my father, older people, and I say that because I'm not young by no means, but when you're used to a certain method of, let's do a 401k,
it's what you know.
And that's what's brought to you and taught to you their entire life. My dad has zero concept of Acorn, Stash, Bitcoin, Ethereum, any of those kind of things, right?
It's all very, very new, but it's also just not what they know.
My point. Yeah. And so when you come up with this stuff and people say, oh, I don't know, it's kind of crazy, because the Flex Method will combine whole life and IUL.
Right.
So it gives you that leveraging of stability of a whole life, because it does give you that on a smaller scale, like a small percentage of it is going into that. And the rest is going into like IUL. So it's like you're getting the best of both worlds. And then again, the biggest point is then they take the bank's money. We talk about taking the bank's money all the time when it comes to real estate.
Everything else.
But when it comes to
don't
this,
use your money, don't use your money, don't use your money.
And that's everywhere, on every platform.
Yeah.
It's taught by every race, color, and creed, right? But when it comes to this, it's sort of like, wait a second, it's a reluctance.
It's new.
It's
new, man. He doesn't know, we don't know it, but that's what we're here for. We're going to pitch it to our people, and hopefully.
Same as crypto, though. It's new.
Right.
I fought, personally, Bitcoin forever. Of course, I have it now.
You got to learn.
Right.
But that's the thing. Like, it takes, and being who we are, Just a little more conservative to jump all the way in.
Right.
But again, once we learn it, once we understand it, man, we're ready to go.
Right. So the bottom line for this one is, and we'll wrap this up, guys, is whole life, we're not going to say it's bad or good. Maybe not our first choice of things. But when it comes to things like an IUL, being your own bank, that's what they're talking about. They're talking about indexed universal life insurance. We're talking about that and combining it with the flex method, which is a combination of indexed universal and whole life, and having the bank be your backer, right? Instead of you sitting there spending
instead of you, exactly. And then you could end up not only saving that money, but also want to borrow against your own growth.
Yeah. The growth is more rapid. The money that comes in is not yours. You're leveraging someone else's assets, which is huge. The bank is definitely going to make their money. You're going to make way more money than the bank, theoretically. That's how this all works. And so the concept of being your own bank is not new, by the way. It's old as dirt, right? People have been doing it forever.
Right.
There you
it's
go.
It's new to us. That's okay.
It is. And so
this is where we start.
Don't run from it.
Right. True.
Learn.
True. Even if you're skeptical, learn.
Call us. Read, and don't take our word for any of this stuff. All this stuff is just, it's
check
every
it.
podcast. Listen, man.
Fact check. No alternative facts. Everybody fact check.
Everything. Because there's a lot of stuff out there that scares me when I read it, because people are just dropping there. It's not the realm of expertise by any means. And I listen to some of the foolishness, and it's, to be frank, it's garbage.
But yeah, we're hoping that our clients in our circles and just anybody looking for something more productive or more progressive is really what I mean. They at least take this information, fact check it, give us a call if you have more questions.
Definitely.
You can check us on all the socials, right?
All the social media platforms. You guys know where to find us. All our information is on the links. But again, whole life, skip that. Being your own bank is real. Being your own bank,
and you can do it. And it's before we go, it's attainable. It really is
all day.
Attainable.
But it also,
we don't think that, but it is. We didn't think that.
So closing it, intentionality, right? You said if that's a word, intentionality.
It is now.
It has to be. You can't look at other people because they've had a ton of time to build.
And everyone's different.
It's different. You have to. Someone has to decide they're going to sacrifice.
Someone
has to plant the tree.
Yep.
Your mango tree analogy. We posted that and reposted it for something else. Someone has to plant the tree.
Someone has to.
And in our community, I think that's the biggest thing. No one wants to plant the tree.
I don't know, man. Our clients do, because we have a few of them that
that's
are
ours.
Signed up.
That's ours.
And that's who we'll take care of.
No, we gotta take care of everybody. Everyone, guys, you all have the ability to do it. Yeah. Dude, somebody has to make the decision to say, I'm going to plant that tree.
Listen to all the trigger words we said.
Man.
Look it up, give us a call, comment, whatever you want. We're here for you.
Have a good one, guys.
TQ Talks, we are out.
Thank you for listening to TQ Talks. If you enjoyed this show, please rate and recommend on iTunes, SoundCloud, or wherever you get your podcasts. You can also get more information at TQFinancials.com.